Welcome to this introduction to ICOs, what they are, how to assess them, and what happens following an ICO. An ICO, or initial coin offering, is the cryptocurrency version of an initial public offering, or IPO, of a company listing on the stock exchange. In an ICO, instead of raising funds by selling shares that will then be traded on a stock exchange, an ICO company creates a fixed number of cryptocurrency tokens that are subsequently traded on a cryptocurrencies exchange. Most ICOs are launched by companies with or in the process of building blockchain platforms. The company decides how much capital they need to raise and also places a valuation on the company it must convince potential ICO investors makes sense. That valuation is then divided by the number of tokens created. The cryptocurrency tokens created can be considered like shares. The ICO will aim to sell enough tokens to raise the capital requirement. One important difference between a traditional IPO and an ICO is that because cryptocurrency exchanges are not regulated like stock exchanges, ICO companies do not have to go through the same strict audit of their finances and company as would be required to list on a stock exchange. As such, assessing an ICO is much like assessing a startup that is crowdfunding from angel investors. The ICO investor must do their own due diligence on the company and decide if they believe in its management, future prospects, and agree with the valuation set by the ICO. After an ICO, the tokens will be listed on one or more cryptocurrency exchanges and freely tradable. Like shares on a stock exchange, if the market believes the company is doing or will do well, demand for the tokens will increase and their price will rise. If the opposite is the case, their value will drop. The original ICO investors are banking on the first scenario and will hope at some future point to sell their tokens through an exchange listing them for a profit.